The conversation we're about to have are the kinds of conversation I have on my podcast weekly. It's called Zero. If you're interested in climate solutions, please listen to Zero. But today we're going to try and focus our conversation on what Singapore Exchange is doing in this space. So let's just to start the conversation, give us an overview of, as somebody who runs an exchange, you are at the forefront of understanding what are the needs of investors and what are the trends that investors are following. So over the past few years, what is it that you have seen as a mega trend, and how have you tried to find solutions for it from an investor's perspective?
Good morning, and thank you, Akshat, and thank you to Bloomberg for having me here. As you mentioned, being an exchange, we are in a unique position at the forefront of the market ecosystem. We look at our roles in three ways. One is a company. How do we run our company? We've, over the last few years, started our net zero pathway. Secondly, the product and services that we offer, which is, I guess, your question around what investors and what trends are we seeing. And then third, I think importantly, at the forefront of the ecosystem, how we try and lead the ecosystem in terms of the sustainable journey. To come to your question in terms of trends and what investors need, I would characterize it as the following. There's obviously one where investors are only starting out new, but they want to get into the journey of net zero and sustainability. And there they would probably invest in funds that will allocate capital into climate resilient companies or low carbon emitting companies. Secondly, there will be those that will be confined to, let's say, aligning with regulations, let's say the Paris aligned regulations. And last but not least, there'll be companies that are really into it in terms of allocating capital and researching companies and helping them in that journey. So we've actually seen a trend where more and more companies and investors are down that journey. And we as ourselves, obviously, will be in there providing products and services like passive indices and benchmarks.
And so if you are new to this and you're just trying to get a feel for it, what is it that SGX is going to offer that would allow you to start to understand what is a complex environment?
I would look at it in three ways. One, allocate capital into ETFs, into the derivatives markets. We ourselves have launched with MSCI a climate action set of indices, which is really bottom-up, sector diversified, that really allocates capital in a rule-based, transparent way, and what most index would do, but really only allocating capital to companies that are on their pathways, transparent about it, and also have targets to achieve. That's one. And two, if you are a more sophisticated investor, they're allocating capital to factors. We provide what we call a climate impact consistent index that really tilt greater weights to the companies depending on their climate performance. We're not looking to optimize at the portfolio level. We're really allocating more weights to the company that are really on that net zero pathways. Third would be carbon credits. We ourselves have partnered up with Temasek, DBS, and Stanchart in Climate Impact X that offers carbon credits for companies that are beginning on that journey in terms of having carbon credits to compensate or neutralize emissions.
So let's split the conversation on two parts here. One on sort of indexes and ESG in general, and another on carbon credits and trading, but also net zero plans. And maybe let's start with carbon credits, because it's something that Bloomberg Green has covered widely. If you search for where the market is today, the issues it is facing, they're quite serious. So you launched CIX over the past year. There have been multiple auctions that have happened, and about 500,000 tons of credits have been auctioned on the market. Now, just for context, Singapore's annual emissions are 50 million tons and plus. So it's still a small fraction relative to what Singapore's emissions are. But the carbon credits and the use of carbon credits have come under huge criticism because most of them, as we look deeper into the market, turn out to be junk. So what is it that you are doing to ensure that what gets sold, because there's demand for it, does not later on turn out to be junk?
Well, as with any market development and new markets, it's going to be a journey. There's going to be issues along the way. I think what is important for the carbon market is for any platform, SGX included, to provide robust information, transparency, and in the end, the market as of now lacks a benchmark price setting mechanism for carbon credits to clear. And like you rightfully said, there are different grades of carbon credit. And what SGX does are as follows. It has a marketplace that lists projects. It also has an auction platform and also recently launched an exchange for spot trading. But I think key to that is for any credits or any projects to be listed, it has to be globally recognized. It should not have any negative taint or linkage to that. It must have sufficient verified unretired credits.
Right.
And last but not least, in that process, any platform, SGX included, is to help companies and buyers of credit in that journey, no matter which spectrum you are at, with the information, education, and then helping them to make their own decision on purchasing any credits.
But when it comes to stock trading, for example, there are rules and regulations in place. You can't have insider trading. You do something that goes against those rules, you get into serious trouble. Now, the entire carbon offset market is based on voluntary rules and voluntary commitments that companies are making. Even these global standards that you're talking about are essentially industry, not-for-profit, sometimes academics coming together and creating those rules. Do you see that there is a need for regulation to ensure that there is not just credibility in the market, but that credibility is backed by laws that would then punish if people do abuse the market?
Well, I think that's the beauty of market evolution. If I give you an example of even at the Singapore Exchange, we are now the largest iron ore market globally outside of China. It started off 14 years ago purely as an over-the-counter market. No, so clearly bilateral, and then it gets cleared on the exchange at SGX. In the last couple of years, they have now been brought onto a rule-based, well-defined clearing mechanism on SGX. And today, the total volumes are now 2 times the underlying. Exactly what you just said. You clearly need time for rules to be developed and evolve. And I think the carbon credit market is just part of that journey. And I think we're just seeing the early signs, the green shoots of what it is. And then with any market, you're going to get some of the issues, but marketplace can come together.
Well, that's different because carbon credits themselves are at least 30 years old. The oldest carbon credit program was created in 1988. And so the journey has been going on for quite some time. So I'm not sure it's the same equivalence that you can draw because the market has been shown to have troubles again and again over the past 2 decades since it started.
Some market lasts for 10 decades, and I think the different markets have a different kind of evolution.
Right.
And for us as an operator of an exchange, in this partnership, that's what we like to bring to the forefront in terms of how markets should be structured, should be developed, and how players should come together, and how the rules should be designed.
Now, one other thing that's happened is obviously all the auctions that you've run have been oversubscribed. But globally, for the first time in 6-7 years, the number of carbon offsets sold declined in 2022 relative to 2021. And part of it is because of the credibility issue that the market is facing. We understand that traders who are working on SGX are struggling to find supply of good credits. Why is that the case?
Well, I think for high quality credits, they're clearly lesser in supply. But I think for any kind of credit, what is important is the transparency And secondly, globally recognized, well-established projects. And then three, I think more importantly, is the continuous monitoring of such projects. And I think that's key to that. And for example, CIX did an auction of the Delta Blue Carbon Project, the largest mangrove restoration project in southern Pakistan. Over the life of the project, it's going to sequester over 140 million tons of CO2. And that, when it was auctioned about 2 years ago, today is trading at almost 40% premium to the current spot price. So high quality carbon credits does have the demand that it deserves.
And just for context, I mean, it's 140 million tons is a huge project. So as looking at Singapore's emissions, Singapore's cumulative emissions as its lifetime over the past, since its independence, are 2 billion tons. So, you're making one project that can make a substantial contribution if it actually works. Now, going to ESG, I live in London, as I said. When I look at ESG, it's sort of a different flavor, but depending on which region you're looking at. There's a whole political backlash in Europe, in America, around ESG, which is getting mixed with Democrats versus Republicans. In Europe, the government, and especially the European Union, is coming out with real big, strict rules, but sometimes those rules are either too complex or too strict, and then there's backlash from industry that there is lack of clarity. When you look at ESG in Asia, what is the flavor of ESG over here?
It's very widely defined, frankly, as you said, and it really depends on the sector and the stage of the economic development of each country. And even if we take the E part of ESG and link that back to environment/climate, let's also not forget in many of these projects that we just talked about, some of those, the corresponding benefits are the social benefits into the community. And that's part of the aspect. And I think critically in this part of the world, and we'll talk about energy transition, I think just transition is important. No one should be left behind. I think it should be inclusive. And I think that's a journey for sectors and companies, and including governments and regulators to all come together to play their role.
So you are seeing there being demand for ESG-oriented investing, and that's the reason you've created the products, or you want to be ahead of the market and you're creating the products because you expect an ESG market to happen. Where are we right now?
We're seeing a good take-up rate as more capital are allocated towards climate transition. As portfolios get bigger, investors will require similar tools at their disposal. So at SGX, we want to be at the forefront. It's never easy to try and predict demand and a trend, but I think climate risk is real, is here and now, and I think it's important that we will play our part in whichever role we are, which company, which sector, and we think investors would require more tools at their disposal. And we at the exchange works with the ecosystem to try and provide the relevant products and services.
Now, there is one way in which you can move capital, which is through indexes where people make choices that weight them towards environmentally friendly companies. But there's another one which you can use, which is exclusion. So you can exclude a certain amount of, say, coal financing, which many banks have done, or you can exclude oil and gas in the Arctic. There are these exclusionary principles that many banks have adopted. Are there any exclusionary principles that you have adopted or are considering adopting when it comes to running the exchange itself?
Exclusion typically happens at a portfolio optimization level. And I don't think that really plays a useful role in any company that is undergoing a net zero transition. you can't turn from a brown company to a less brown or a new company tomorrow. I think what is important is in that journey, capital is being made available for company who wants to go on that transition, who are very clear on what are they emitting today, what forward targets do they want to set, but more importantly, a very near-term intermediate step to demonstrate that they are really on their pathways and continuously achieving, disclosing, and being very transparent with that. And I think one of the ways to look at that, as I said earlier, whether that is the MSCI climate action indices that we do, that really rewards company on that journey, continuously monitor you, or if you're more sophisticated in the climate index, considered index that we have, that really allocate more capital, the better you are as a company in your climate performance.
The trouble is when you look at what's happening in the world right now, heat waves in Europe, floods in China, it's very hard for people to see that climate impacts are growing. Emissions haven't actually declined. We had a record emissions globally last year. And so even as companies are making plans and there are targets to try and keep them on track, observe if they're doing what they say they will do, surely there's a point where there's not enough progress. Somebody has to draw a line and say, okay, we've given you enough time, we've monitored your progress, you're not making enough progress. What's the punishment? What happens when that moment is reached for a large company that's either trading on the exchange or as part of an index?
I think financial markets can play an important role. And I'm very glad being part of the Glasgow Financial Alliance for Net Zero, part of the Principals Group. We're going to launch a new work stream globally that SGX will be part of that to mobilize capital towards companies that are really making that effort. And I think for investors, the pressure of climate change is real. I think we can all play our part to try and allocate capital to help companies in their pathways.
And when you look at Singapore specifically, what are the types of conversations that, given all the products that already exist, but the rapidly changing environment in which ESG operates, what are the kinds of products that are on the horizon that investors want, or what are the kinds of needs that they come to you with that make you think, okay, I need to work on this?
What we're really seeing in terms of demand and pickup rate is really in the barbell part of the investing. Passive investing via indices, but very clear and transparent around only capital being allocated, increasingly only the companies that are performing better in their climate journey. And then the other one is really allocating capital directly to companies. And then what we're also seeing in between is carbon credits. And I think carbon credits are here to stay, notwithstanding some of the challenges that we see. And carbon credits doesn't need to be a consequential action that companies or anyone take. It is not after a broad footprinting, knowing your emissions, then you look at carbon credits. It could be in tandem, it could be in parallel, because you can use that for compensation, for neutralization of emissions.
That's great. Well, thank you so much for taking all the questions, and thank you all for listening. And if you enjoyed this conversation, I hope you'll tune into Zero Bloomberg Green's podcast that comes out every week. Thank you.
Thank you.